Welcome back to the Deep Dive. Today, we have a really vital mission. We're building you a bulletproof financial blueprint. Whether you're a teenager just getting that first W-2 or you're a parent trying to guide that journey, this deep dive is your shortcut. We're going to synthesize some key strategies to turn that income into real independence.
And we're really focusing on prevention here, on proactive habits. And here's something critical right away. Study after study shows that parents are the single most influential factor in a child's future financial behavior.
That's huge.
It is. So if you're listening, you have the power to shape decades of success.
Yeah.
Our job today is to break down the 3 most common mistakes young people make so they can be, completely avoided.
Okay, let's unpack that first major hurdle. We're calling it the 100% consumption trap.
Yeah.
It's sort of ingrained assumption that every single dollar you earn is, well, it's just there to be spent immediately. It feels natural.
It does feel natural, but it's financially crippling. I mean, look at the data. Over 67% of Americans are living paycheck to paycheck. And when you zoom in on young adults, say 18 to 27, only 15% are saving any portion of their paycheck. Without a plan, the money just disappears.
It burns a hole in your pocket.
Exactly. The whole mindset has to shift from just consumption to conscious allocation.
Conscious allocation, I like that. And the tool for that is a budget, right? Or what we like to call a spending plan.
A spending plan.
Okay.
And we're going to dive into what we call the 3 S's of budgeting.
The 3 S's.
Yeah, which is a big part of what's known as a zero-based budget. Now let's pause on that term for a second.
Good idea.
A zero-based budget just means you give every single one of your dollars a job to do. Your income minus all your planned expenses has to equal 0. It just forces you to be intentional.
Exactly. And a really popular framework for teens use those 3 S's, saving, spending, and sharing, often with like a 20-70-10 split. We saw this with Shane, the pizza delivery driver, in one of the case studies.
Right, Shane. He was earning about $800 a month, and he just needed a structure. So he used the 20-70-10 rule.
So how did that break down for him?
Okay, so the first S is saving. For Shane, that was 20%. Or $160 a month. And this is where you have to use the golden rule. Pay yourself first, PYF. Before he even thought about gas or headphones, that $160 went straight into his savings. That's your seed money for emergencies, for investing. The discipline is so much more important than the amount at first.
Okay, now I have to challenge that 70% for spending. That was $560 for Shane. Is 70% really a good target if you're trying to get ahead quickly?
That is a fantastic point. 70% is really just a flexible starting point, especially if you're covering your own needs like food or gas.
Right.
But if you're living at home with very few expenses, you should be aggressive. Lower that 70% to 50%, maybe even 30%. The spending category is where you have to learn the difference between needs, essentials, and wants.
The luxuries.
The luxuries. So 70% is the absolute ceiling. It's not the target you should aim for.
And the final S is sharing. So about 10% or $80 for Shane went to charity.
Yeah, and this just builds that muscle of giving back. It's an important part of understanding how money works in the world.
So how do you make this actually happen? Like, what are the steps?
Okay, 5 steps. First, you capture your reality. Record every single source of income. You can't manage what you don't measure. Second, you do a behavioral audit. Track every penny you spend for a month. See where the money actually goes. Third, define your mission. Set clear goals. Saving $500 for a trip or whatever it is.
That's the motivation.
That's the motivation. Fourth, you create the map, put the 3 S's into your plan. And fifth, you tweak the compass. You make adjustments. If your audit shows you're overspending on wants, well, that's where you have to cut.
That adjustment part, that's where you find what you call the money leaks.
Yeah.
This is where it gets really practical.
It is. And money leaks are so insidious because they feel tiny, like that odd $1.50 vending machine snack every day.
Or the fancy coffee.
It's an easy purchase to justify in the moment. But that $1.50 snack every single day is $547.50 a year. You could have bought a new laptop or funded a big chunk of your emergency fund with that.
It's the small, consistent spending that really kills your long-term wealth, which brings us to banking. You need a system to protect yourself from those leaks.
Absolutely. We strongly advise having at least 2 bank accounts. One checking account for your weekly spending.
Okay.
And a separate savings account that's harder to get to. Use technology. Automate the transfer. The second your paycheck hits, send 20% to savings. And here's a pro tip. Don't link your debit card to your savings account. If it isn't easy to touch, you won't touch it.
Let's shift gears to the second major mistake.
Yeah.
The immediate overuse of credit. This is such a common trap. And the numbers are, frankly, a little scary.
They are.
Over 15% of Gen Z credit card users have a maxed out card. And more than 10% are delinquent, meaning they're at least 30 days late on a payment.
And that delinquency rate just shows how much they underestimate the cost of interest. They see credit as free money. It's not. It's very expensive borrowing.
So let's make that tangible. You use your card for a $100 concert ticket.
Okay.
If you only make the minimum payments, and your card has a pretty typical interest rate, say 25%, that $100 ticket can end up costing you over $250.
Ouch. And that debt starts compounding against you. So prevention is everything. You need a few key principles.
Like what?
First, the 30% utilization rule. This is golden. You have to keep your balance under 30% of your total credit limit. If your limit is $1,000, never carry a balance over $300. It protects your score and stops that interest snowball.
And second, you have to understand payment timing. The difference between the statement date and the due date is critical.
Ideally, you want to pay the full balance before the statement even closes. That way, the company reports a low or a zero balance to the credit bureaus.
Okay, the third principle.
Critical thinking. Before you swipe that card, you have to ask 2 questions. Do I need this right now? And can I afford to pay this off in full immediately? If the answer to that second one is no, you wait.
And that discipline saves you, because that credit score, you called it a financial passport. Why is it so important to protect it early on?
Because it's required for almost every major financial step you're going to take. Getting a good rate on a car loan or a mortgage, renting an apartment.
Even getting a job sometimes.
Sometimes even getting a job, exactly. Damaging it when you're young just makes everything more expensive for years to come.
So how do you build a positive history before you even get a card?
You just show you're responsible with any bills you do have. Manage a checking account well, pay things on time, cell phone bills, car insurance, even parking tickets. Those companies report your payment history. Then, when you are ready, get one card, use it for small things, and pay it off in full every single month. That's all you need.
Okay, so let's talk about the antidote to that credit trap, which is investing. If debt makes compound interest work against you, investing makes it work for you, which means time is the single greatest advantage a young person has.
The power of compounding over 50 years it's just incredible. Let's run the numbers. Imagine 2 people. Both save $100 a month and get let's say a 10% annual return until they're 65.
Okay, person A starts at age 15.
Person A starts at 15. They'll contribute a total of $60,000 over their lifetime. But at age 65, their total wealth will be almost $1.4 million.
$1.4 million.
$1,396,690 to be exact.
Yeah.
Now, person B, they wait until age 22, just a 7-year delay.
Okay.
Person B contributes $51,600, so not that much less. But their wealth at 65, it's only $710,810.
That's almost half.
That 7-year delay cost person B nearly $700,000 in lost growth. Time is just irreplaceable. That is the key lesson.
That's the most compelling reason to start immediately. But what are the logistics? You can't just open a brokerage account when you're under 18.
Right. You need an adult custodian. The most common way to do this is with a custodial account. You'll see the acronyms UGMA or UTMA.
Let's quickly decode those.
UGMA is Uniform Gifts to Minors Act. UTMA is Uniform Transfers to Minors Act. They're basically just accounts an adult sets up to manage investments for a minor until they turn 18 or 21. For retirement, you can also start a custodial Roth IRA.
But there's a catch with the Roth, right?
A crucial catch. You must have earned income from a job to contribute.
Given that long time horizon, how should a young person think about risk?
They can afford to take on more risk than someone who's, say, 55. Riskier investments like stocks have higher potential returns, and because they have decades for the market to recover from downturns, and downturns will happen, they can capitalize on that.
But you still have to be honest with yourself.
Always. You have to be honest about your personal risk tolerance. If a market dip makes you panic and want to sell everything, you've taken on too much risk, even if you're only 16.
So let's keep it simple. What are the main asset classes they can access?
The superstar for any young investor really is funds, specifically index tracking ETFs or mutual funds. They invest in a huge basket of assets, so you get diversification built right in.
And they're low cost.
Low cost, passive, and they have a proven history of solid returns. It's the perfect set it and forget it option. Then you have individual stocks, much riskier. And finally, bonds, which are lower risk but also have lower returns. Not really ideal for a young person focused on growth.
Okay, so 5 practical steps for a teen who is ready to start investing. 1, educate yourself. 2, set clear goals. 3, select investments. Start with a simple index fund. 4, open a custodial account. And 5, buy the investment and keep buying it consistently.
Okay, let's move to that final big mistake. Not storing money safely, leaving it vulnerable to theft or, much more common now, online scams. Your money needs to be in an FDIC-insured savings account where it's safe and earning interest.
And teens are huge targets for these digital threats. They're digitally native, sure, but they're financially inexperienced. So we need to hammer home the red flags. If something online seems too good to be true, like a 200% guaranteed return, it is. Legitimate scholarships never, ever charge you an application fee.
And any request to wire money or give out your social security number or bank info, that's an immediate full stop.
Can you give us a few specific scams to watch out for?
Sure. First is the inexpensive luxury goods scam. You see these crazy deals on social media. They take your money and you get a cheap knockoff or just nothing at all. You have to buy from verified retailers.
That's another one.
Scholarship guarantees. If they charge a fee or guarantee you'll win, it's a scam to get your data. And third, and this one is subtle, social media surveys.
Oh, the what's your secret elf name? Quizzes.
Exactly. They seem fun, but they're collecting answers to common security questions. Your mother's maiden name, your first pet's name. They use that to hijack your real accounts. Just avoid them.
And finally, let's touch on something nobody loves, but everybody needs to understand. Taxes.
The dreaded T word. But it's essential. You have to know why that money is leaving your paycheck.
Right. Why do we even pay taxes? They are the fuel for all the public services we rely on. Police, roads, schools, defense, parks.
So when you get that first paycheck and see a chunk is gone, you need to know where it went. There are a few key types.
Like sales tax.
Right, sales tax is added to stuff you buy. When you get a job, you'll see federal and state income tax taken out of your paycheck. This is where you learn the difference between gross income and net income.
What you earn versus what you take home. And most importantly, FICA tax.
FICA is just a payroll tax that funds Social Security and Medicare. It's the money collected now that pays for your retirement and health insurance way down the road. Just understanding that these deductions fund your future is the most important part.
Okay, so let's synthesize all of this.
Financial literacy is a superpower. It really is. And it's gained not by, just avoiding big mistakes, but by building solid, boring habits early and often. It's the best investment you can make in yourself, and it pays off for your entire life.
And that idea of consistency is what we want to leave you with. We saw how compounding turns small, steady savings into massive wealth. What if you applied that same principle to your habits and your knowledge? So what small financial habit tracking you're spending per week, automating a tiny $10 savings transfer, asking that critical question before you click buy. What will you commit to starting this week so your future self can compound that wisdom? Choose one, start now, and feel that powerful momentum build.